Crisis talks are continuing tonight, our time, but it seems the signs aren't particularly positive. Matt Sherwood is the head of investment market research at Perpetual and has been keeping a close eye on developments in Greece. Matt, welcome to The Drum.
Thanks for having me.
We've heard a lot about the potential for a Greek default, but what would a Greek default actually look like in Greece?
Well, what it would look like is that the default itself would probably not be that significant because the Greek budget outside interest payments is actually in surplus at the moment. So you might actually get a bit of fiscal support, a bit more spending. But to the global economy and global markets, it would look very different. It would be a very serious event and could have potentially serious ramifications around the whole world.
If one of the things that then happens after default, and is it assumed that one leads to the other, that they would then drop out of the eurozone, stop using the euro as a currency, and then be back to a new drachma or something?
Yes, well, in the end, the default and the leaving the euro are separate decisions, but in many ways they are binary because if you default, the European Central Bank cuts off support to the Greek banks. They go into meltdown. All of a sudden, the economy goes into a deeper depression. So how do you support your economy then? You need an exchange rate depreciation, so you have to leave the euro. So in many ways, I think those two decisions are combined. And of course, this is a very big moment in the European Union's history.
One of the arguments in favour of default and leaving the eurozone has been actually that's a pretty good way to get out of an economic hole, decouple from the euro, get your own currency that you can drive down into the basement, and suddenly you've got an export-led recovery. You're back in the game.
That's true. And if you look at it just from that sheer lens, yes, it does seem constructive and positive. But what happens when you do default, the ECB cuts off the support from the Greek banks, they go into meltdown. So all of a sudden, your banks are in default, they're illiquid, they can't trade, so therefore you have no financial system, therefore credit's cut off, unemployment would double, above 50%, so it would be utter chaos.
And there'd be a rush on the banks as well, wouldn't there?
Absolutely, that would be the first thing, is you'd get the drachma.
So your savings are in euros right now,
That's
but
right.
then what happens?
What would happen is people would start withdrawing money from the banks. That would cause a bank run, so therefore the banks would become illiquid. The ECB's just cut off the life support to the bank, so therefore the whole system goes down. And then Greece would have to nationalise the banking sector, but it doesn't have any money, so therefore it will have to borrow money off people it's just defaulted on to keep the banking sector alive. And in many ways, they would do that.
And of course, the interesting thing here, right, is it's a bit like, it's not so much we're talking about Greece now, but we talk about this contagion risk being that the idea and the fear that this might happen to other countries spills over. It's like when you remember in 2008, when Lehman Brothers, the investment bank, went under, that caused everyone to flip out. And it wasn't so much that people worried about Lehman Brothers going under. It was the fact that people realised, oh, an investment bank can fail and no one's going to help them. And so everyone started asking the question, who's next? And now we're at this point, right, everyone's terrified that if Greece was to go, then it shows that countries can pop out of the eurozone and everyone starts asking who next. But Matt, can I ask you a question? Because we've been talking about Greece and thinking about Greece for years now.
Yep.
Do you think this is possible that now it's just gotten to the solution is very simple. There's only one way out. Greece has to leave the eurozone?
Well, I think the first question is what do they do with their debt? And in the end, there's only three possibilities this time around. They either do a deal, they do a delay, which is what they've done for 6 years, as you said, or they default. They're the three options they have. Now, two of those are good for the economy, good for markets. One of them's catastrophically bad. So in the scheme of things, if they actually do default, I don't think it's going to be a Lehman's repeat for a couple of reasons. One, it's not so much of a surprise. Lehman's was a massive shock from nowhere.
Yeah, we've been warming up for, 2 or 3 years for this?
That's right. But and the other reason, of course, is the European Central Bank has got all these firewalls which they think can ring-fence the contagion from Greece reaching into other economies like Spain, Portugal, Italy or even Ireland. So I tend to think, yes, you'd have quite a violent reaction in markets, but I think the crisis would be over in a couple of months. So it's not going to be like Lehman's, which just went on and on and on. So, and I think that's beginning to be the majority view in Europe, that we can get through this.
What about potential implications for Australia? You'd have to say that we're maybe more vulnerable to an international economic shock than we were in 2008, 2009?
I think we probably are, but the good thing is the shock would have to come from Asia more so than Europe. So I tend to think Glenn Stevens and Joe Hockey would be comfortable that if they can ring-fence a contagion risk to Europe, that Australia would be okay. If we had something like a China financial crisis, Now that's a very different kettle of fish, and that would be catastrophic for our economy, not only because we have such massive trade links with China, big investment links, but also, the simple fact that, we're out of policy ammunition pretty much in Australia. Monetary policy's exhausted. Yes, the exchange rate could come up and Joe Hockey could do a bit more stimulus, but you don't have much interest rates, and RBA can't do a QE, of course. So,
yes, so finally, Matt, do you have a tip as to where this is heading from here?
I tend to think that Greece is going to have to end up defaulting. In the end, they have twice as much debt on average of the European peers, and they have twice as much debt as what they produce in economic output each year. There's three ways out of a debt crisis. You either grow your way out, you inflate your way out, or you default your way out. Greece can't grow, they can't inflate, and that only leaves default. And these constant lifelines they keep getting given, to me, really are resolving nothing. The reforms aren't doing anything. So I think inevitably they will have to default.